Modern artificial intelligence networks require gigawatts of continuous, unbroken power. They cannot rely on intermittent sources like wind or solar. They need the dense, baseload energy that only nuclear power can provide. Enter BWX Technologies. With the nuclear renaissance accelerating, we have to ask, is this specialized supplier the ideal pick-and-shovel infrastructure play for the AI boom, or has the market already priced in its entire upside? To understand their defensive moat, look at the U.S. military. BWXT is the single exclusive company in the United States licensed to manufacture and supply nuclear reactors for the Navy's Columbia and Virginia-class submarines. You cannot disrupt this business from a garage. Replicating their footprint requires spending billions of dollars on specialized infrastructure to process highly enriched uranium, alongside clearing decades of strict federal regulations and securing thousands of engineers with high-level security clearances. That impenetrable monopoly on defense contracts produces guaranteed bedrock cash flow, and BWXT uses that reliable federal money to fund highly speculative next-generation commercial technologies. Their balance sheet rests on three pillars. The first and largest is government operations. Building out these massive submarine facilities and processing special materials accounts for roughly 80% of their total revenue. The second pillar is commercial operations. Here, they step outside the defense sector to manufacture critical components for civilian power plants and design advanced small modular reactors for the commercial grid. The third pillar is their rapidly scaling medical isotopes division. They manufacture specialized radioisotopes used in cancer treatments and diagnostic imaging, a completely separate market that is currently maintaining double-digit year-over-year growth. By diversifying away from pure defense procurement into commercial energy and healthcare, they lower their exposure to single market downturns and drastically raise their ceiling for long-term top-line growth. Now we need to audit the actual ledger. Does the internal math at BWXT justify the market's enthusiasm? This bar chart visualizes their recent revenue acceleration. In fiscal year 2025, they generated $3.198 billion. That represents a steep 18.3% increase over the previous year. As the chart transitions into a margin breakdown, we see what they actually keep. After operating costs, they retain a gross profit margin of about 15%, indicating healthy pricing power for a heavy industrial manufacturer. But watch the visual morph into a balance scale. They currently hold a 1.64 debt-to-equity ratio. This means for every dollar of shareholder value, they carry $1.64 in debt. Think of it like a mortgage on a rental property. They are using manageable leverage to finance rapid expansion. And here is how they manage that leverage. In 2025, the business generated $295.3 million in free cash flow, the actual liquid money left over at the end of the day, which routed directly into debt paydown and strategic acquisitions. The ledger reveals a highly levered, cash-generating engine. They are intentionally suppressing their short-term profit margins to aggressively fund production capacity for the future. That rapid capacity expansion introduces internal threats. When they launch massive new government programs, the initial profit recognition is very low. This creates a margin drag while the customer-funded capital expenditures slowly spin up. Externally, their heavy reliance on the government exposes them to geopolitical risks. Any delay in Navy procurement schedules or cuts to the defense budget immediately threatens their bottom line. This friction recently led analysts at Wells Fargo to initiate a strong sell rating on the stock. They pointed directly to year-over-year margin drops in the government operations segment as a sign of underlying profitability concerns and execution risks. Grounded, holding this stock means accepting immediate margin compression and the chaotic swings of federal budget cycles, all in exchange for a decade-long runway of guaranteed work. The ultimate catastrophic threat to this thesis is Washington gridlock. Because 80% of their revenue is tied to federal budgets, a prolonged government shutdown effectively stalls their primary cash pipeline. If you want exposure to the AI power boom without the friction of defense budgets, Constellation Energy provides a direct commercial alternative. Or you could look at Vistra, a company maximizing the output of existing nuclear power plants rather than risking capital to develop unproven next-generation reactor technologies. Choosing BWXT over those utilities means you are betting specifically on their unique ability to navigate strict federal regulations while simultaneously pushing into commercial markets. The stock currently trades at a steep premium of 57 times earnings, but last year their backlog of guaranteed future orders grew by 50%, reaching a staggering $7.3 billion. When you align that backlog with management's 2026 guidance, projecting earnings between $4.55 and $4.70 per share, the current valuation begins to look highly rational. Look at this calculation for our final verdict. We rate the stock a buy. By taking the median estimated earnings of $4.62 per share and multiplying it by a conservative 56 times historical forward multiple, we establish a 12-month price target of exactly $260 per share. As the graphic expands, you can see the ultimate tension of the stock, the extreme safety of a $7.3 billion regulatory moat weighed directly against a 1.64 debt ratio and compressed margins. Does the massive federal backlog justify the leverage for you? Let me know your target price or your favorite alternative nuclear play in the comments below.